This is a deep dive into the Amphi mutual fund inflows for the month of July, which came out yesterday. I promised yesterday that I would give a detailed analysis. I've just completed my analysis, but before I start it, I must tell you that there are a lot of tables which I need to show. So what I'll do is I'll do it on a post. So please do remember to, after hearing this, please read my post. It will be on YouTube, Facebook, and LinkedIn, and all of these places, right? So the first thing first is, yes, as you would have read in many places, there has been a 15% drop in the equity inflows for the month compared to the month of June. It's now come at roughly about 25,000 crores. But when you dig deep, you'll find there's a lot of analysis and a lot of things that the investors are trying to tell us through their actions. So yes, there has been a drop month on month. But was it a drop because of sales or because of profit booking? That's the first question to answer. So when I split up the active equity, the number which is reported is 25,000 crores is only for one portion of the equity universe, which is the active equity. There are other things which we need to consider, which we will discuss. So the first is that in active equity, the drop of 15% in net flows was caused not by less sales to the month. The gross inflows or gross purchases, whatever name you want to call it, were up 3% month on month. But there was a 16% spike in the redemption, that is profit booking. Now, people either book profit to take it out of the equity market, which to some extent happened because there's an overall 15% drop, or they might have taken it and put it into another scheme. So that's how the net figure comes in. So the 16% spike, which is almost 6,000 crores of profit booking this month. So that's the first factor to remember, that the problem was not about inflows, but about people taking money out of their particular schemes. Now, then when you look at it and look at the SIP inflows, they were stable, right? Roughly, I think about same around 32,000, 31,800, 900 crores. So the SIP component of it has remained the same. So the people who are investing are again continuing to give the money. There is no fear there, right? Now, when you look at the schemes, then, like I said, this redemption could have come back into some of the scheme. So what has happened is this month is that very clearly people have moved away from safety. Now, what do we understand by safety? Safety is large cap, flexi cap, right? Large and mid cap. These are the perceived safety. So if you see there, large cap especially, not only are people shown a 27% drop in putting fresh money into large caps, but there is a 36% increase in the redemptions in large caps. So for some reason, and we'll, at the end of the program, I'll try to tell you what I think it is, people have moved away from a large cap, and even flexi cap and large and mid cap to some extent suffered this, but the biggest was the large cap, right? And what happened to that money which they put it out, right? It went into small cap, the other extreme of the risk reward spectrum. Small cap is in fact one of the categories which received a net inflow also. So the net inflow they received was 2,200 crores. Given the size of the category, that's a significant amount. And how did this come about? There was an 11% increase in fresh purchases, which means more people are desiring to put money into small cap, but there was also a drop in the redemption from small cap funds by 20%. Now, large cap, I said there's a 36% increase in redemption. In small cap, there's a drop in redemption. So clearly, people who are already invested in small cap are saying, I'll stick to small cap. And there are fresh people wanting to put money. So the big news of the market is that people want to move away from safety into high risk, right? That's one point. Now, the second point that I want to make there is, if they have moved out of large caps, then people say, no, in large caps, funds managers are not able to beat the index. So then are they going to passive? So is this large cap money moving on going to passive? Because this reported number that I spoke doesn't include passives. That's the way the media reports it, right? There's a separate segment called passives. Now, when I looked at the passive, there are two kinds of passives. There's an index fund and there's an ETF, right? Now, ETFs are far bigger in size than index funds because provident funds, big institutions put money more in ETFs. Index funds are a mix of provident funds, HNIs, and some retail also. So if you break up this, yes, index month, last month was a negative small amount, 150 crores negative. This month has become positive. So you'll think, yes. So people have money moving from large cap to passive. No, The reason for the increase in the index funds was because of the reduced redemption from Nifty index funds, not because of fresh flows being higher. So if you see there, right, I saw that in index funds, there's a reduction in redemptions as the gross purchases were down only 1.5%. So the gross purchases were down in index funds, but they still showed 1,500 crore positive because there's a sharp drop in the redemptions, right? That's the reason why index funds showed so. Whereas you go to ETFs now, it clearly bears out that there was a 3,700 crores fall in net flows, which was because there's a 14% drop in gross purchases. So it's very clear that people didn't move from active large cap to passive large cap. Passive large caps also experienced a outflow of a significant amount, right? So clearly that's the case. So there we now know about the active plus passive schemes. Now there's one more category which again doesn't get highlighted, which is called the hybrid category. Your typical, conservative hybrid, aggressive hybrid, balanced advantage, multi-asset allocation. That segment also, which is seen as a safer part, right? Less volatile because there's a mix of debt, mix of gold in it. That also saw net outflows month on month. So you see that hybrids as a safe category also lost month. In fact, balanced advantage was a negative flow for this month, right? And even multi-asset funds which contain gold and silver in it, even that saw a sharp drop. So there was a drop even in hybrids. So another thing to take off saying, again, people don't seem to want safety, right? That is those who are remaining or actually invested, right? Because overall, remember, there's a drop in the flows. So this gold, multi-asset funds in gold also saw outflows, right? So then what about the real alternative way that people choose gold? Now, as you know, gold has been very volatile in the last month or so, right? So the volatility has scared off people. So not only have multi-asset allocation seen a drop, in the gold ETF also there's almost a 1,900 crore drop in net inflows, right? So that's the 42% drop in gross purchases. The profit booking was less than last month, but there's a drop in. So clearly people have got a bit, I would say, scared of the volatility that's seen in the gold prices. So that again, if you see gold as a safe haven, again a move away from safety, right? So to summarize the overall situation now, to end my thing, is that overall, yes, there is a 10,000 crore drop in the equity available to fund managers to invest. If you add all of these categories, in hybrids I've put my own percentage. Like I said, please read my note because the table attached will be there, right? So this is the total flows into equity plus hybrid plus gold, 10,000 crore less. But if you take pure equity and take in the effect of that, it's about 7,300 crores less for mutual fund managers to put compared to the previous month. Partly explains why this month domestic mutual funds have been a little less biased than earlier, right? Partly explained by this because DMFs are not the entire DIS. There's LIC, there are insurance companies and all of that. But partly it explains, I think, customers also have given 7,000 crore less money to the mutual fund to put into equity schemes. Now, finally, I want to say, why is this? Why this shift from safety to this? And there, if you come and see, right, and look at the performance as of July 31st between the 1 year, 3 year, 5 year, Nifty, mid cap 100 and small cap 250, you'll see that there's a huge difference in the returns over 1 year, 2 years, and 3 years. More nearer, there has been some correction, so it's okay. But across the thing, the mid caps and the small caps have beaten handsomely the large caps across this 1 year, 2 years. So investors are looking at the returns, they have a tendency to chase the returns where they go. And so that's probably been one of the causes to the fact that though we have seen a drop in the total equity funds available to fund managers, whatever money is coming there is coming more towards the small cap and the higher risk category. And that's why you will see that from a buying support to the fund, the industry, right? Small caps and mid caps will probably get more buying by the DIRs because that's the money they've got, right? I hope this explains. And do remember to read my written note, which will contain all the tables substantiating the data that I have been quoting. Thank you. Good day.